Welcome to this lesson on the quick ratio, also known as the acid test ratio. The quick ratio is one of the most important liquidity metrics in corporate finance. It helps us understand whether a company can meet its short-term financial obligations using only its most liquid assets. This makes it a stricter and more conservative measure than other liquidity ratios. The quick ratio is a liquidity metric that measures a company's ability to meet short-term obligations using only its most liquid assets. Unlike other liquidity measures, the quick ratio focuses exclusively on assets that can be quickly converted to cash. It's called the acid test ratio because it tests whether a company can survive immediate financial pressure, just like an acid test reveals the true nature of a material. The formula for calculating the quick ratio is straightforward. Take the total quick assets and divide them by current liabilities. Quick assets are the numerator at the top of the fraction, shown in blue. Current liabilities are the denominator at the bottom, shown in red. The resulting number tells us how many dollars of liquid assets the company has for every dollar of short-term debt. Quick assets include cash, cash equivalents, marketable securities, and accounts receivable. These are assets that can be converted to cash quickly, usually within 90 days. However, inventory and prepaid expenses are excluded from quick assets. This is a key difference from the current ratio. Inventory takes time to sell and convert to cash, while prepaid expenses cannot be converted back to cash at all. You might wonder why inventory is excluded from quick assets. The reason is simple. Inventory takes time to sell and convert to cash, making it less liquid than other current assets. A company might have valuable inventory, but if it needs cash immediately to pay bills, that inventory might not help. It could take weeks or months to sell inventory, especially during economic downturns. This is why the quick ratio provides a more conservative view of liquidity. Let's work through a practical example. Imagine a sample company has $50,000 in cash, $30,000 in accounts receivable, and $20,000 in marketable securities. These add up to $100,000 in quick assets. The company has $80,000 in current liabilities. Dividing $100,000 by $80,000 gives us a quick ratio of 1.25. This means the company has $1.25 of liquid assets for every dollar of short-term debt. Understanding what the quick ratio tells us is crucial. A quick ratio greater than 1.0 indicates strong liquidity, meaning the company has more liquid assets than short-term debts. A ratio between 0.5 and 1.0 is generally considered acceptable, though it depends on the industry. A quick ratio below 0.5 raises liquidity concerns, suggesting the company might struggle to pay its immediate obligations without selling inventory or securing additional financing. Let's recap the key points. The quick ratio provides a stricter test of liquidity than the current ratio by excluding less liquid assets. It excludes inventory to focus only on the most liquid assets that can quickly be converted to cash. This makes it ideal for assessing a company's immediate ability to pay debts without relying on inventory sales. The quick ratio is an essential tool for investors, creditors, and managers who need to evaluate short-term financial health.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.